Anytime you're fortunate enough to make money, whether from an employer or your own business or an investment, you typically owe federal and any applicable state income taxes. This video will review what investors should know about taxes so you're prepared to pay them. Hi, I'm Laura Adams, an award-winning personal finance author and Money Girl podcast host with over 43 million downloads. For over a decade, I've helped millions of readers and listeners understand how to manage money and build wealth. Our goal is to offer tips and advice that you can put into action for more financial security and success. The first thing investors should know is that different types of income get taxed differently. You're probably familiar with ordinary income, which includes earnings from a job or running your own business. For instance, you might earn wages, salaries, tips, bonuses, commissions, rents, or interest income. For 2024, ordinary income is taxable according to 7 brackets ranging from 10 to 37%. However, certain types of investment income, including long-term capital gains and qualified dividends, are taxed differently. Some taxes are due only if you choose to sell an investment for a profit, and others are due when you get paid a distribution. Another consideration is the account where you own an investment. For instance, with a tax-advantaged retirement account, like a 401k or IRA, you only owe taxes when you take retirement withdrawals. Or with a Roth retirement account, you get tax-free withdrawals in retirement if you own the account for at least 5 years. Your earnings, gains, and losses are irrelevant from year to year because retirement accounts give you tax-deferred growth. But for investments you own in a taxable brokerage account, taxes are due when you earn interest, receive dividends, or choose to sell an investment for more than you paid. For instance, if you buy 1 share of stock for $20 and sell it for $30, you have a $10 capital gain. But remember that a capital gain is only taxable if you realize it by selling the asset. If you have an unrealized gain, also called a paper gain, it's not taxable. You can watch your asset appreciate and won't have to pay capital gains tax until you choose to sell it. Let's say you have a $10 gain and own the stock for a year before selling it. In that case, you'd have a long-term gain, which is taxed at reduced rates, currently ranging from 0 to 20%, depending on your total taxable income and tax filing status. Note that some investments have higher capital gains tax rates. For instance, collectibles like rare coins and art typically have a long-term tax rate of 28%. But owning an asset for less than a year means capital gains is considered short-term, and your short-term gains get taxed at the higher ordinary tax rates, which, as I mentioned, range from 10 to 37%. So owning an investment for longer helps minimize taxes, especially for high earners. Also, if you have a capital loss on an investment, you may be able to offset other gains or take a tax deduction depending on your situation. So if you want to defer taxes, you want to own investments inside a tax-advantaged retirement account. Just be aware that tapping a retirement account before 59.5 means you must pay taxes on any amounts not previously taxed, plus an additional 10% early withdrawal penalty unless you qualify for an exemption. A brokerage account is flexible with no restrictions on deposits or withdrawals, but doesn't give you any tax benefits. To learn more about investing and retirement planning, visit finder.com. Thanks for watching. If you like this video, please subscribe. You'll get notified when there are more helpful product reviews, money tips, and advice.